Hello, everybody. Welcome back to another segment of News You Can Use. So, for those of you who do not know me or are new here, my name is Maya, and today is Wednesday, August 23rd, and I'm happy and excited to be here with you guys today, sharing the latest updates and insights that can truly make a difference in your life and business. So, for today's segment, I'm going to be sharing with you guys the most relevant news, trends, topics, and practical tips so you guys can use them in order to stay ahead of the game, especially if you apply them right away. So, without further ado, let's get ready for a very enriching and informative session that will empower you to have an edge as you are building your business. So, let's get straight into the first thing that I want to share with you guys. So, American workers are demanding almost $80,000 a year to take a new job. So, the amount of money that most workers want now to accept a job has reached a record high this year. Employers have been trying to keep pace with the average wage demands, pushing the average full time offer to up to $69,475, which is a 14% surge in the past year. The numbers are significant in that wages increasingly have been recognized as a driving force in inflation. So, the amount of money that most workers want now to accept a job has reached a record high, and this is a sign that inflation is alive and well, at least in the labor market. And according to the latest New York Federal Reserve Employment Survey that was recently released, the average reservation rate wage or the minimum acceptable salary offered to switch jobs rose to $78,645 during the second quarter of 2023. That's an increase of about 8% just from a year ago and is the highest level ever in a data series that goes back to the beginning of 2014. Over the past 3 years, which entails the COVID-19 pandemic era, the level has risen more than 22%. The number is significant in that wages increasingly have been recognized as a driving force in inflation. While goods prices have abated since pushing overall inflation to its highest level in more than 40 years in mid 2022. Other factors continue to keep it well above the Fed's targeted rate of 2%. The New York Fed data is consistent with an Atlanta Fed tracker, which shows wages overall rising at a 6% annual rate, but job switchers seeing 7% gains. Employers have been trying to keep pace with the wage demands, pushing the average full-time offer up to $69,475, a 14% surge in the past year. The actual expected annual salary rose to $67,416, which is a gain of more than 7,000 from a year ago, and also it is a new high. And though there was a gap between the wage workers wanted and what was offered, satisfaction with compensation and upward mobility increased across the board. With markets on edge over what the Fed's next policy step will be, more signs of a tight labor market raise the likelihood that policymakers will keep interest rates higher for longer. And at their July meeting, officials noted that wages were still rising at rates above levels assessed to be consistent with the sustained achievement of the 2% inflation goal. And the survey resulted to also show some other mixed patterns in the labor market. Job seekers, or those who have looked for work in the previous 4 weeks declined to 19.4% from 24.7% a year ago. That came as job openings fell 7,038 to 9.58 million. And this is according to the US Bureau of Labor Statistics. The likelihood of switching jobs fell, dropping to 10.6% from 11% a year ago, while expectations of being offered a new job also declined, falling it into 18.7% from 21.1%. And moving forward, mortgage rates soar over 7%, and unaffordable housing market is becoming even more expensive than what it already is. So an already miserable, unaffordable housing market is getting more expensive. So as mortgage rates top 7%, the highest that they've been in 21 years, according to Freddie Mac, homebuyers facing ballooning costs. Some housing experts are warning that the rates could keep climbing toward 8%. So what does this mean for house hunters? Even ever optimistic real estate pros are saying that buyers and sellers must adjust their expectations. So Bess Friedman, the CEO of Brown Harris Stevens, a national real estate firm, says that he doesn't like to be doom and gloom. This is his book for business. He also says that I still say real estate is the best long-term investment, but there has been a shift. It is flawed for people to assume that just because inflation has started to move in the right direction, that mortgages and mortgage rates will go down too. And despite recent reports that inflation is cooling, it is still too high and the economy too hot. And for the housing market, that is not good. The fact that we are seeing rates at these highs is having an impact on the housing market, Friedman said. Rates have doubled, inventory is constrained, prices are elevated. Those three things are creating a sluggish housing economy. And there is little to suggest much of that will change in the near term. Given the Federal Reserve's continued concerns about inflation, which puts further rate hikes back on the table. Could rates go higher? Possibly. It's also said that we're not seeing any catalyst for them to go down. And because of that, people have to get their minds wrapped around where the rates are right now. So impact on the housing market. As rates for a fixed 30-year mortgage have surged during the past 31 months, up from the lowest weekly average of 2.65% in January of 2021, the payment made by a home buyer of a median price home who put 20% down has risen by more than $1,200 a month. This has pushed buying a home out of reach for many, many people. Buyers who are still in the market are finding historically low available inventory. And because mortgage rates were so low during the pandemic, with people buying or refinancing into loans at 2% or 3%, there is very little incentive for them to sell and buy another home at 6 or 7% higher. And due to the low inventory, prices are staying elevated. Median home prices hit their second highest level on record in June at $410,200. They were just less than 0.9% than the all-time high of $413,800 hit just the year before. We are at a critical conjuncture, says Lawrence, who is the chief economist for the National Association of Realtors. Minutes from the last Fed meeting, which was released this week, revealed continued concerns about inflation if the economy and labor markets don't cool down, suggesting another rate hike may be on the table during the three remaining meetings this year. That, along with Fitch's downgrade of US debt, have exerted upward pressure on longer term borrowing rates. This week, the yield on 10-year US Treasuries crossed over 4.2% threshold and has been bumping up against to 4.3% on Thursday. It's the highest level in over a decade. That's a tipping point. If it breaks past that, then the momentum, however irrational, could push it up toward 5%. That's bad news for mortgage rates, which correspondingly may rise to 8%. And at the current average mortgage rate of 7.9%, the buyers of median price $410,200 home will pay $2,203 a month in principal and interest, according to calculation using a Freddie Mac tool. In January of 2021, when the median home price was about 100,000, lower at 309,900, and interest rates were more than 4 percentage points lower at 2.65%, a home buyer locked into a $999 a month payments. The increase in mortgage rate is exacerbating housing affordability as home prices are climbing in this limited inventory environment, says Jessica, who is the deputy chief economist at NAR. Something has to give for rates to calm down, and that something is the next decision by Fed. So how did we get here? This isn't where forecasters thought that we'd be. We thought that mortgage rates would be much lower by now. All these Fed rate hikes were intended to slow inflation down much more quickly, but the economy has defied the rate hikes. Fed officials hiked interest rates to the highest level in 22 years, and although the Fed does not set the interest rates that borrowers pay on mortgages directly, its actions influence them. Mortgage rates tend to track the yield on 10-year US Treasuries, which moved based on a combination of anticipation about the Fed's actions, what the Fed actually does, and investors' reactions. When Treasury yields go up, so do mortgage rates. The market is pricing in the potential for another rate hike. And there is a fair amount of risk in the economy. At this point, lenders are taking note of that risk, keeping rates higher. And the banks are protecting themselves. Banks are trying to protect their bottom line. Unfortunately, for home buyers, rates could go higher and are expected to stay elevated. The consumer continues to spend and hiring continues. Inflation will only truly drop when people are spending less money and there are fewer jobs. As long as the employment situation remains as strong as it is, it will be harder to get inflation down on an ongoing basis. The Fed will hold 3 more rate setting meetings this year, which is in September, November, and December. The rest of the year, we're going to be waiting to see what the Fed is going to do. And Khan says, I don't see any true relief until next year. And moving into our next topic is how the price of New York City subway rides have went up for the first time in years.